Good Saturday morning to you and welcome to On the Mark along with Mark Papa. I'm Gary Byron. Mark Papa is the owner, CEO, CFO, Financial Resources Group over in Glastonbury, Connecticut. Now, you can find them online at www.frplan.com. FR, Financial Resources. frplan.com. More importantly, I want you to take this phone number down and give it a buzz. It could be the most important and significant phone call that you make for yourself ever in your life. I mean that wholeheartedly. 860-657-8380. Again, 860-657-8380. And if you missed any of those points of contact, no worries. I'll repeat them at least a couple more times before the show is over. Mark, good morning. Great to see you.
Hey, good morning, Gary. How are you?
Good. You're looking dark. You've been hanging around outside or go on vacation? Or
Yeah. Well, no, not vacation yet, but it's been pretty interesting with, the outdoor sports are over now. Mm-hmm. The weather's here, so I'm going to definitely take advantage of being outdoors a lot more than being trapped all winter and then all spring for that matter. So I finally have some good weather, so I'm going to take advantage of it.
As you should. As you should. I have this conversation all the time. Work hard, play hard, right?
Yeah.
Some people say work hard, play harder.
Well, if I played as hard as I worked, I probably won't live too long.
So. It's all in how you play, I guess.
Yeah, moderation, more like it.
Well, everything in moderation. Mark, last time you had us all checking the fine print on our bond funds, if you remember, last Saturday morning, and then we promised people kind of a two-parter. So I want everybody welcome back to that.
Yeah, I wanted to continue that conversation because that was prior to Kevin Warsh in his first Fed meeting. And what a lot of people were predicting, I actually said on my show that he may not immediately raise interest rates, but he can change the sentiment. And that's exactly what he did. So I said, because of the pickle he's in, the only way for him to move anything or make any movements would be more psychological. And the Fed's very good at letting people know what they're going to do. This happened in 2021 into 2022. They told us they were going to raise rates. Right. Now it's very clear to many. I think we could see at least one rate hike by the end of the year. And that's having some issues in the bond market. So I wanted to bring this show together so that I wanted to widen the lens because to understand the risk in bonds, you have to understand what I just said about what the Federal Reserve is trying to do. And I said that last time. And I'm not here to cry wolf. You can either take my advice, listen to me or not. You can one way, protect yourself. And the other way, you can just, listen to who you're currently working with and say, hey, stay the course. But good luck with that advice.
Right.
Or you can actually do something and be proactive, as this is how we operate. So the not only is that what happens is when you raise interest rates, growth stocks struggle, right? So that means the AI and the chip sell-off that we're seeing could also be related to rising interest rates or the potential of rising interest rates. And that trade's starting to look a little bit tired, and it carried a lot of people who are sitting on this show. You did great in 23 when we should have probably had a down market or a recession because of AI. Did great in 24 and 25, but guess what? Now we're starting to question that. So we're going to go over all those topics today, Gary.
It's a lot of ground to cover, so let's pick up where we left off for anyone who missed part one, by the way.
Okay. Well, here's the heart of it.
Just kind of give us a 30-second version of it.
Yeah. No, exactly, Gary. And this is exactly why with our full checklist, we show people exactly how bonds work and what can happen when interest rates rise. And we show them how much bonds can actually lose. And they realize that at that point, at the beginning, we get them to tell them, oh, that's for safety, that's for interest, that's the safe part of my portfolio. So when someone tells you they're conservative, Gary, I say, well, okay, what do you have for bonds? Then I look and see, oh, boy, gee, you have a bunch of bonds that are kind of risky. Then you have a bunch of bonds that have, 10, 20, 30-year maturities. In an interest rising rate environment, you can get absolutely crushed. And then you're not making your money back till rates come back again. So what happens is when you need that money, people start liquidating those bond funds, you're left holding the bag. And that's where you want to be, or do you want to be, again, proactive? So that's why you need to call me or go to www.frplan.com and book an appointment. If you have bond funds or even target date funds for that matter, they're chock full of bonds that money moves into bonds whether you like it or not. That's just how they're designed. So the relationship is mechanical again. When rates rise, the market value of existing bonds fall, And so in a rising rate environment, higher for longer environment, which we may be looking at, the very thing people own for safety can lose value. It was very painful in 2022. The 30-year Treasury lost almost probably about 30%. The bond ag lost around 12% roughly, which is the benchmark. It's like the S&P 500 for bonds. It's called the Barclays. It used to be called Barclays Ag. Now it's the Bloomberg Ag. So you really need somebody who can pick through your portfolio and with a fine-tooth comb and figure out where that risk is going to be and then do something about it.
And the bond, the risk hides in two places.
Yeah, exactly. So remember I talked about duration, the long maturity of the bonds. And this is just a recap of a couple shows ago, but I can't stress this enough. I said I'd rather repeat a show so that sinks in, right? You know, you have to watch the Burger King or I shouldn't say that, any commercial 7 times, 8 times before it actually sinks in what that commercial is. Which is why they play the same commercial over and over again, right? It's 7 times. And our attention spans are much shorter than they used to be. So yeah, when rates rise, rates increase, bond values fall. And when rates get cut, bond prices go up. And that's what we've been living. We lived all the way up to 2022, had that environment. But bonds were great, stocks were great. But the minute they raised those interest rates, Look what happened to stocks and bonds got crushed.
And I remember you showed folks last time how to actually look that all up on Morningstar.
Yeah, I mean, you could pull the fund up on Morningstar. You click the portfolio tab, and you look at the average effective duration and maturity breakdown. In a duration of 8 means roughly an 8% drop if rates rise 1%. Now, if you're in something labeled income and you find a duration of 8 or 9, then you might be taking far more risk than the name implies. And in a rising rate environment, the shorter duration, generally 3 years or less, is your friend. That's where we parked most of our money. We made that decision on April 28th, Gary. Then I saw what Warsh was going to do, or at least heard about what he wanted to do. Mm-hmm. I took it seriously, and we got out of those long treasuries and put it into the short-term treasuries. And we're going to start just park there and wait and see.
Okay, so before we get to the Fed, walk us through the mechanics one more time. Why exactly do bond values fall when rates rise? Because a lot of people, they nod along, but they never quite get it.
Well, it's just the simple equation. There's an inverse relationship between bond prices and interest rates. So if interest rates go up, bond values go down. And it's no different if I remember I gave you that example. If I bought say $1,000 bond or $10,000 in bonds and it was paying me 4% today, that's $400 in income. The problem is if rates rise to 5% and I need to sell my bond, it's only paying 4%. New money can buy that same $10,000 bond and make 5% or $500. So we have a simple calculation where we divide the old interest rate into the new value, the old interest rates divided into new value, and that gives you the loss of the bond or the discount you would have to pay to sell your bond. So I need to make 5%, Gary, because I can get that at the bank or wherever. Yours is only paying 4%. In order for me to buy your bond, I still need to make my 5%, which means you have to sell your bond at a loss or a discount to me in order to buy that bond. That's the problem. And hopefully, if you ever need that money for whatever, it's in an emergency, and you're in that bond fund, and everyone else is bailing out, you're liquidating at a loss. So you want to make sure you're protecting yourself.
So, all right, the safe long-term bond can actually be the riskiest one in a rising rate world, let's say.
Exactly, and that's what happened in 2022. It was shortly after. I mean, you looked at things like crypto crash, but look at those banks that made all those risky loans. They took a big hit because they had invested a ton of money in long-term treasuries. And some of those banks, Silicon Valley Bank, Republic, they went under, remember, or had to be bailed out, basically. So currently, many of our large money center banks still own hundreds of billions of dollars of long treasuries. And the unfortunate part, they don't have to report it on their balance sheet because they just say, well, those are long-term assets. We'll hold them to maturity. And this way they don't have to mark the loss on their books every quarter when they report their earnings. So that's another thing if rates go up. We're going to start hearing that. A third thing is private credit. I've pounded the table on and being very, very careful with private credit. More and more stories are starting to unfold. More and more people want redemptions. Less and less people are getting redemptions. And these are from major, major, major names. And I'm also a little worried that systematically could hurt some of the insurance companies out there who, life insurance companies especially, who invested in those deals. But we'll save that for another program.
All right. So then let's talk about the man that's really steering all of this, Kevin Warsh,
Well,
the Federal Reserve Chair. What is he actually trying to do? And really, how is it different from what we got used to over the last decade or so?
Yeah, this is a really interesting transition. To understand Warsh, you have to know his track record. So he served as a Fed governor through the 2008 crisis. And for years afterwards, he was probably one of the most prominent voices warning about the Fed's easy money policies and how that creates bubbles. And by the way, before we go any further, I also want to mention Alan Greenspan.
Yeah, he passed away at 100 years old. Yeah.
Legendary Fed chair passed away.
Just this past week.
We want to give our condolences to Alan Greenspan. He's a very special chair, probably one of the most prominent celebrity Federal Reserve chairs, but also probably one of the smartest guys.
Well, and he was married to NBC News reporter Andrea Mitchell. What made him so celebrity-like?
I mean,
and renowned.
People started watching the Fed when he became chairman. I think it was 87. He had to manage the crash of 87, and then he had to manage the thrift blow up. He had to manage the 2000s, where he felt he did kind of take the blame after his career for that. I don't really blame him for that.
No.
And plus, what I was also read about him, he studied both monetary policy, which is more Milton Friedman economics, and I'm going to put the audience to sleep if I talk about that any further, and then Keynesian economics, which is more, a different type of economic, more government-led, more government stimulus, more government and quote-unquote spending to stimulate the economy. But he didn't take a side. He just called the shots as they were, and that's why he was so famous. But he was probably one of the smartest guys we're ever going to know, and he did a lot of good things for the Fed. So I give him credit.
100 years old. Rest in peace there, Alan Greenspan.
But, so what Warsh didn't like were the near zero term rates, right? So massive bond buying programs that we call quantitative easing. So they're buying bonds. They carry long-term costs. And he also consistently argued for a smaller Federal Reserve balance sheet and for the Fed to do less, basically, let the economy work its way out. And for the Fed to get out of the business of distorting markets and to protect the institution's credibility on inflation, above almost anything else, protect your credibility on inflation. So none of what he's doing now should surprise anyone who followed his commentary over the years.
Okay. So break everything down. Let's start with the balance sheet. What is it, and why does shrinking it matter to my bonds?
Well, first off, in order to not shrink it, basically means you're growing it at this point. So if you think of the Fed's balance sheet as an enormous pile of bonds it bought during the easy money years, so trillions of dollars of treasuries and mortgage bonds. Remember, in 2008, they were buying 2021 during the COVID era, they were buying stocks too. They're pumping up the market like crazy. And then now when the Fed buys bonds, it pushes their price up and their yields down, right? Because there's demand for purchasing.
Right.
They're buying. So if you buy too much of anything, what happens to the price eventually, right? It goes up. But then the yields get pushed down. It pumps money into the system. That's called stimulus. Okay, that's pumping money into the system. That's a monetary stimulus style, different than fiscal stimulus, which is government spending or tax cuts. Okay? So that, a lot of people don't realize that tax cuts are a fiscal stimulus at the end of the day, but they are. Now, Warsh's goal is to reverse that, to let those bonds roll off and shrink the pile. So the process is called quantitative tightening. And remember, I talked at that last couple episodes ago about that steepening yield curve and how it scared me and how we moved money into short-term treasuries. That's what we may not be exactly right in the short run, but I'm looking at the long run. We don't invest for the short term. We invest for the long term. And I have a feeling that I know, by the way, it's not a risky trade. It was a smart, more conservative move in the bond portfolio for fixed income we have. And I felt that's a much safer place to be. I'm not going to be compensated for my risk in 10, 20, or 30-year treasuries. Plus, we have $40 trillion in debt. Would you buy a company that was indebted by $40 trillion or even, $400 billion in debt? That's not a company I'd buy. So why would I do that? So I don't want to be on the hook for that long because God only knows what's going to happen. So just going back to that. So that's stimulus, and then letting the Fed balance sheet shrink is tightening. That's taking money out of the system. And that's disinflationary in a way because it's tightening. That helps fight inflation, no different than raising interest rates. So make no mistake about make no mistake, it's bonds which puts upward pressure on yields. And remember the seesaw that I talked about? Higher yields mean lower bond prices. Lower yields mean higher bond prices. So a shrinking balance sheet is a headwind for bond values, and that's directly why I'm cautious.
And on interest rates and inflation, what?
Well, Warsh's North Star is credibility on inflation. And his view broadly is that the Fed lost some of that credibility by being too low for way too long. Powell was criticized very, very heavily by Wall Street. I think part of that, in my opinion, is we didn't know what was going to happen with COVID. We didn't know the vaccines were going to work. And he let it ride. Now, should he have acted sooner in the rearview mirror from a Wall Street pundit's perspective, who was probably underperforming the market and he needed, those rate cuts or whatever to be, it's kind of hard to say. I don't. The talking heads drive me crazy. So, but at the end of the day, my opinion was I gave him a little bit more leniency because we didn't know what was going to happen with COVID. But once we started seeing the economy open up, that was when it was time to start cleaning house a little bit. But, they did it in 2022 and they raised very, very aggressively. It hurt the market for a year, but look where we are today. We're much higher than we were in 2022. And there's a lot happening. That hurt the credibility by being too slow. And, the biggest problem is some of the central bankers, they could declare victory way too early, and then inflation can come roaring back. That's kind of where I feel like we are right now. Now, some of that had to do with oil prices popping. Some of it had to do with Iran. But you can't, just because you have a couple good quarters of declining inflation, doesn't mean that the problem is solved. So you got to be really, really careful what you do. So he's inclined to keep policy tighter for longer. And I think he's kind of waiting to see the whites of their eyes. Okay. And to be very sure inflation, is dead before they ease again. So that's the opposite of what the markets were hoping for. They wanted a quick, aggressive rate cut, and everyone, we all know that that's been dead for a long time. At least, a long time in the market is at least 6 months, in my opinion. So if Warsh is running, the playbook he's advocated for years, people betting on a fast return to cheap money may be disappointed. So I don't think we're going to see that. And that's a scenario where bond owners, especially long duration owners, get hurt and you can't get out of those bonds. And now you're stuck with them.
What about the geopolitics of it all?
Well, that's the other issue here. You said it before with Iran, and again, there's a lot of progress happening, and at the same time, there's a lot of politics happening, and so they don't believe our rhetoric, we don't believe their rhetoric, so we have to hopefully let them negotiate a deal, and hopefully come to some terms, and then it's a wait and see, right? It's a wait and see. We don't know what's going to happen. I mean, these people have been warring forever. So Hezbollah and Israel and Lebanon and Hamas, they've been warring forever. Are they going to change their tune on a dime? I don't really think so. And then the Iranians at the same time, I mean, they know we mean business. They're coming to the table and we'll see. But, I don't ever think that we're ever going to put that fire out.
Folks, you're listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is the owner of Financial Resources Group out of Glastonbury. You can find him online at frplan.com and by calling this phone number, 860-657-8380. As a matter of fact, you're going to want to call it at the end of the show. He's got something of value that you could obtain absolutely free. It's about a $2,500 value, and it's more than just a checkup, folks. Everybody offers a checkup to some degree. This, you will not find a more thorough checklist than what he will go over with you momentarily. Mark, this isn't just an American story, though, because I know that you wanted to point out that central banks around the world, they're all kind of moving in the same direction here.
Yeah, and they are. They're starting with the Japanese. I mean, the Japanese have been more than ever in the history, raising interest rates. They were at zero or negative interest rates for many, many years. They're, have their own demographic issues with population and aging and everything else. But the bottom line is they've been increasing interest rates. Guess what? People borrowed Japanese yen at $0 and were buying stocks in the U.S. It was called the yen carry trade. Well, by raising interest rates, that blew up that trade. And that actually caused a lot of volatility in our own markets. So we have to look at, it's not just the U.S. looking to raise rates. The ECB, for the first time in nearly 3 years, Gary, raised a quarter point last week. Australia, there's been they've raised rates 3 times in 2026. the Norwegians a quarter point. To 4.25, and then the Bank of Japan and others like Turkey, Russia, Brazil, and South Africa, they maintain high rates, high rate adjustments. And major banks like the Fed have been on hold or easing mode, but shifting expectations. That's what's exactly what we need to work. The expectations are shifting towards flatter down to now up. So we have to be very careful about that and always check. We have to check the latest announcements to see what's going to happen with that.
But why should a stock investor even care that a central bank in Europe or, I don't know, Japan raise their rates?
Well, essentially, it just shows the trend, right? They're adjusting to our policy. They're adjusting to maybe strengthening dollar or weakening dollar. So they're making adjustments as along the way. Because remember, the dollar is the world's reserve currency. Now, that's becoming less and less, and they're seeing more and more trade in Chinese yuan, according to the Wall Street Journal. But less and less. Since 2010, the dollar has been less and less. But at the same time, it's still the world reserve currency. So other central banks need to make those adjustments.
I mean, all right, so let's make that turn.
And I can clarify that comment if you need me to.
Well, I mean, do you want to take a minute and do that?
Yeah, because one of the most important ideas of all investing in stocks is basically the value of its future profits discounted back today. So let me repeat that. A stock is worth the value of its future profits discounted back today. So when interest rates rise, that discount rate rises as well. Okay, which means that the value of the future profits are worth less in today's dollars. Does that make sense?
Okay. All
right. So rising interest rates means the future profits are worth less in today's dollars. So higher rates mathematically push stock valuations down, and all else equal, it hits the most expensive, fastest growing companies the hardest. And that's why we're seeing, some of these chip stocks sell off big. Some of the AI trade being questioned. Some of the returns that these hyperscalers are going to make. They had tons of free cash flow, which is cash flow above and beyond all expenses. And it used to be super high. It's actually going down to zero because of all the money they're spending, all the borrowing they're doing to build out these AI data centers. And this AI race is just being questioned as to where's the return? Where's the beef? Remember that old commercial? Where's the beef? When's the beef coming?
Well, the AI names and the chip stocks have been, they've been the market's darlings. And lately, they've kind of taken it on the chin. What's going on there?
Well, I think for this very reason, I think that valuations have been stretched. Now, you can make a comparison of AMD and Cerebras, right? Cerebras was a newly public company. It's taken a big hit since its IPO. It's trading at like 100 times, earnings or sales. But then you look at AMD, right, which is an important chip company next to NVIDIA, only trades at 11 times forward earnings, or NVIDIA, which trades approximately 21 times, where the S&P is trading at 22 times, and it's growing like crazy. So, but you have to be careful that when, again, in a rising rate environment, anything that's growing or is ahead of itself, and I think what they did, they shifted the bias because they see a bubble forming. That's what the Fed does. They see this bubble forming, and they want a correction, and we need a correction. There's some of these stocks are, they're parabolic moves to the upside, and it's getting out of control. So I think it isn't a bad thing that we're seeing the sell-off, and it tends to be a summertime thing anyway.
Is this a buying opportunity or a warning?
If you're a long-term investor, I would say, there is a crux. There is an argument for a bear case. It's a fair one, but the hyperscalers are spending a crazy amount of money, right? And they're buying up a bunch of chips, and at the same time, it seems software companies are very vulnerable to, because of Anthropic. But they're buying up tons and tons of chip companies, but there's this massive divergence that's happening. And, there's a huge demand for chips and massive bottlenecks. So it's getting more and more expensive to be a hyperscale because there's not enough of chips, not enough of power. And people are just starting to be, Wall Street's going to start questioning these things. So it isn't such a bad idea if you're looking, remember, the sum of all future earnings are starting to be threatened. Not a bad idea to pull back and reevaluate. Right. And that's exactly what's happening here. But for certain companies, I think, again, with the help of someone like myself and how to position, we can definitely pick through the wreckage. But our main crux, Gary, aside from all this wonderful information, there is no better trade that we've made this year then was diversification. Again, we're trending above the S&P 500's returns in our model portfolio. Our all-equity portfolio is doing tremendous. We're not taking big hits to the downside. And if you look at what's done well, small caps, emerging markets, we've done very well with mid caps. We've done very well with international. If you were diversified, you're a happy camper right now. You're not feeling this. Now,
right,
if your advisor had you in growth, chasing all these tech stocks, you're feeling some pain right now.
I got to wrap this up.
Major downside.
Do you have a disclaimer?
Yes, I do.
Okay. Why don't you do that quickly?
Of course, got to get that done for the compliance department and for the regulators. Yes. Okay, so the opinions expressed during this program are those of Mark Papa personally and do not necessarily reflect the views or positions of Financial Resources Group, LLC. All investments involve risk, including the possible of loss of principal. Nothing discussed in this program constitutes an offer to buy or sell any securities or investment products. Past performance is not indicative of future results, and Financial Resources Group, LLC is a registered investment advisor in the state of Connecticut. Always consult a qualified financial professional before making any major investment decisions.
Well, you are that qualified professional. Really quick, why should someone call you on the heels of this show? And what's this $2,500 value that you're giving away here this morning?
Well, the first thing is, again, not to be an alarmist. I'm not trying to scare you. Here's the bottom line. I know where the bodies are buried in every portfolio. I've been the firm's port manager for 6 years. I've built my own models for 10. I stopped working with third-party managers many years ago, and it's been a trial and error process, but I've got the scars on my back to prove it. Experience. That's why you want to call me. And I want to help people avoid these pitfalls with both stocks and bonds in a rising rate environment. And we did very, very well in 2022 relative to the market. So we've seen this before. So you want to be with somebody who's seen it, not somebody who is fresh out of college or, who might be a sharp advisor, but maybe has 6 or 7 years experience or maybe even 10 years experience. I've seen 2001 to crash. I've seen a lot of different crashes. So, but you want to call me, you want to come in and get the full checklist as well. It's a $2,500 value. Typically, we find significantly more savings than what that $2,500 value is.
Yeah,
and sometimes in the tens of thousands. And if we're talking about an investment career, it's hundreds of thousands, if not more.
Give you that number right now. Call right now. The first 5 callers, you are going to be pleasantly surprised. I told you at the top of the show, probably be the best call you've ever made for yourself. 860-657-8380. Again, 860-657-8380. Financial Resources Group in Glastonbury. Find them online at www.frplan.com. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark with Financial Resources Group. Until next Saturday morning, have a good one, everybody. So long.